super panel here that we're going to cover a lot of topics. We're going to cover both the investment side, the opportunities around debt, but also what we're seeing in financing markets. Thanks very much to everybody joining us here. If hearing is difficult there at the back, you can pick up headphones and that will give you the sound coming clearly through. So do use those if you would like to. And thank you very much to everybody joining us online. For those who don't know me, my name's Richard Betts. I'm the co-founder of Real Asset Media. This is our stand, the International Investors Lounge. We're collaborative by nature, and our focus is really on research, insight, strategy, the kind of things that are driving the market. We also report on the market, but we see ourselves very much as writing for, not about the markets, if that makes sense. That was my 30 seconds on that. And our task is to do the same introduction for yourselves, taking 30 seconds. And we'll start with you, David, at the end. So, David, quick introductions.
Thank you. Welcome, everyone. Thanks for joining us. My name is Dave White. I oversee the real estate debt business for LaSalle. We're a pan-European business. We lend from Germany west, inclusive of the Nordics, United Kingdom. We cover anything from senior lending, development lending, whole loans, levered whole loans, pretty much you name it. We're in the real estate debt business.
Great. Hannes.
Hi, Hannes Wimmer, representing Erste Group. We are a senior secured lender to the eastern part of the European Union and to the Balkans. We don't do Western Europe. I'm heading loan capital markets, so the real estate loan syndication business is with me. And yeah, looking very much forward to it.
Great. Duco.
Hi, I'm Duco Mook. I'm with CBRE Investment Management, the investment management arm of CBRE. I'm heading the Treasury and Debt Finance Department for Europe. So I'm on the borrower side, day in and out in the market, responsible for debt and hedging strategies and executions as well.
Great. Matthew.
I'm Matthew Featherstone. So I oversee the debt advisory and structured finance business for Newmark across Europe. For those of you who don't know, Newmark are one of the largest listed commercial real estate advisors in the world. We advise on all forms of financing, from development financing, investment financing, covering all real estate subsectors.
And are you across the whole of Europe as well, Matthew? Or?
Correct.
Okay, great. And last but very much not least, Laurent.
Hi, my name is Laurent Heiliger. I'm the managing partner of RSM Luxembourg. RSM is an international association of independent members active in the tax audit advisory. We are 65,000 people worldwide in 120 countries. And my work is focused on private equity and real estate, advising clients, structuring their investments, and implementing them from an administrative and corporate perspective.
Great. So we've got a breadth of experience and knowledge about the markets here on the panel, including some deep dives into CEE, for example, with you, Hannes. So very interesting, and the borrower perspective. If you've got any questions, do please ask them. We'd be interested to get your views as well. So do ask questions if you've got them. Let's I suppose just start. If we look at EXPO 12 months ago, what's changed? What's different? What have you seen in terms of the evolution, I suppose, the changes in the market? Let's start with you, Dave, if we can.
Thanks. I think 12 months has been an interesting 12 months, that's for sure. We've seen transaction volumes improve and then fall away when America decided to implement tariffs, which no one understood, and then have come back. And so I think that there's been a lot of movement around consumers' affordability, tenants' ability to afford their occupational habits, and on the other side of that, build costs have also gone up. So it's been an eventful 12 months from a geopolitical perspective. It's also been an eventful 12 months from a financing perspective. There's been more capital flowing into the system. Historically, the last couple of years, we've seen a large component of our book in refinancings. So in the debt business, we do generally like to see acquisitions, assets buying and selling, liquidity in the market. That was very light for 23, 24. It started to pop up in 25, and then it dropped in April, and it's slowly been ticking back up. We're still at about half of where we were pre-COVID, though. So it's starting to see some semblance of normality, but at the same time, we're still in a state of polycrisis. So interesting 12 months, that's for sure.
Okay, good. Matthew, what's your take on it?
I think the key difference is that we've seen a huge return to the market from traditional lenders, so mainly local and international banks. Going back, the risk premium increased, so they generally surrendered and moved away. But what we have seen is actually the leverage appetite and pricing has actually materially increased over the past 6 to 9 months especially. So from, say, a senior loan perspective, we've seen senior LTVs increase from 55 to 60 plus, and also credit spreads materially below 200 bips, trending towards mid-ones and even lower from a European perspective.
Okay, good. And it'd be interesting to get your take on that, Duco, as well.
I think the last 12 months have been very interesting. If you go back 12 months ago, not all lenders were active in the market. Definitely now I recognize what Matthew just said in the sense of the local traditional banks that have been very active. What has driven that, in my view, is that after the downturn, so basically the rise of interest rates in the second half of 2022, many lenders were overexposed to real estate and then they needed to rebalance their portfolio, which was basically not easy in a lacking transaction market. Assets were not disposed, loans were not prepaid and basically extended. 2 years down the road, which is roughly where we are today, these banks have their house in order. They come to the market with revised strategies, potentially in new asset classes, potentially in new sectors, and they clearly have a plan. So for best-in-class product, and that differs a bit per country and per asset class, but for best-in-class product, I would argue there's plenty of liquidity and even a borrower's market, which was definitely not the case 12 months ago.
Okay, good. And I guess, Hannes, from your point of view, are you seeing similar trends in CEE, or is it, are you at different stages in the market?
Yeah, we're always like a little bit behind the curve, but we see what's coming towards us. So I would say from our perspective, not only the market values have found the floor, they are also now recognized by the owners and by potential buyers that this is now the new basis where you negotiate from and not cling to the older ones. And also I would say that there is lots of liquidity in the market. Bond market has opened up for investment grade outfits again. So this takes a little bit of time to come into the market, but I guess transaction volumes will pick up with that funds available.
Okay, good. And Laurent, what's your take? Obviously, you're seeing things from a slightly different perspective, but what are you seeing in changes?
I think I see the same trend. Lending has improved in terms of prime products for long-term investors, but remains very difficult for distressed assets, short-term investors. And so for core products, we see a big improvement, but not for the rest.
Okay, good. Duco, you mentioned the interest rates. Let's just pick that up a little bit. What's your expectations? Do you think they're going to be static from now? Do you see a different move? And what's the influence on that for the real estate side and financing?
I think the interest rate curve is extremely important for the real estate sector. People continue to talk about high interest rates versus low interest rates. In my view, what was really difficult for the market was basically that interest rates went up more than the market was anticipating. So not only increasing as an influence, a negative influence to the sector, but in particularly the volatility and the fact that it increased further than the market expected. Where we are today, at least in Europe where we are today, is that the interest rate curve has normalized. Short-term rates are lower than long-term rates. Inflation is relatively where the ECB wants it to be. And I think we can say that the ECB is either at the end of the rate cut cycle, maybe there's another cut to go, I don't know, but at least we're definitely at the end there. You see it in the curve is normalized. It's very important for borrowers as well. It gives you the option to extend your debt on a short term at lower cost of debt rather than long term. Next to that, for real estate, it's very important to know where your long-term debt is. You will not have, if you decide to get debt in place, you will not have it in place, and you will not have your rate fixed within 3 to 6 months. So a stable outlook is very important for the real estate sector.
Okay, good. Matthew, Dave, do you have a view on that, on the interest rate side, or picking up Duco's points?
Yeah, it's interesting. I had someone the other day say when interest rates come back to zero, values will recover. And I think that I struggle to see that. I think, to your point, I think they're pretty normalized now. From a lender perspective as well, we spend a lot of time talking to investors, and it's funny because, for a while we were told, real estate debt was interesting because you're getting such high returns relative to where interest rates were, and it's less interesting now. I think, I struggle with that because I think that actually this normalization allows us to deploy It allows us to get more comfortable in terms of where valuations should be. We can pick where we want to be in terms of basis, and you're going to see a less volatility, and we're still going to find attractive risk-adjusted returns. And so I think that the secondary effect to all of this is you're starting to see a little bit more normalization in the lending market throughout Europe, which is refreshing.
And I also think the capital markets largely stalled because a lot of lenders were waiting for, or sponsors were waiting for interest rates to soften. And obviously that hasn't happened. So actually the kind of bid-ask spread in terms of where assets are going to trade is more realistic now. So we should see a more fluid functioning capital markets, which we well received from everybody.
Okay, interesting, good. I wanted to pick up a little bit just in terms of some of the challenges that we see in the market at the moment. Obviously, those have changed slightly over the year because last year, in many of the discussions we were having, financing just simply wasn't available, or it only just started to be accretive, or so there was a completely different topic of conversation. But I suppose, let's just pick up on the availability of it. What we're seeing is it available for everything? What are we seeing in terms of what people are prepared to finance, what you can borrow on? What are we seeing? Is it across all sectors? How do we see that?
Happy to take this one. First and foremost, I would say that for prime and core product, there is availability. But when we say there is availability, it means basically that there is liquidity from the traditional banks. But still, I would say that pricing is quite scattered. You can definitely have pricing starting at, let's say, 150 bips over all the way to 250 bips. And every bank that making an offer will really believe that they have a high chance of success winning that deal. So that also means that amongst the banks, they have difficulties to read the market and to really know where pricing actually sits. So if you look at ultimately what we are able to achieve and to present to our investment committee, these outcomes are great because you only need one bank. But if we look back and we look back to the market, then I would say the market is still quite scattered from a pricing perspective, but also from a risk perspective. It's difficult to say that the traditional banks will hold the LTV at a maximum of 55 because it depends on asset classes, on countries. It depends on their own book. Maybe they're over allocated to a certain country. Many factors play a role, which is difficult for us, but also for the rest of the market to interpret it.
Okay, good. Yep.
It's interesting. Pre-GFC, we had a pretty common phrase, which is there's no bad assets, there's just mispriced assets. After the GFC, we realized that there are a few bad assets out there. But I think the principle still exists, right, where this is all pricing. And academically speaking, you start with looking at something on an unlevered basis, and then you layer in debt levels in terms of affordability and risk-adjusted return. And that analysis will show you that actually there should be availability for debt for most of the assets that exist in this world today. I think it's still coming back into play for alternative lenders. We found some spots that we really like in less common areas where we're comfortable with the cash flow today, cash flow tomorrow, and how we value that cash flow. But I think on the other side of that, there is a lot of price discovery that still has yet to happen. I don't think we're sitting here, at the bottom collectively. It's less of a thematic conversation. It's far more about, individual asset level understanding and then building from there. You obviously need the macro support, but you can't sit here and take views thematically and assume that everything's just going to go up because interest rates have normalized. And so for us, we're very comfortable pricing pretty much anything. It's really just, are we getting to a point where we're in agreement with our borrower on what value is and what a business plan should be?
And CE, it'd be interesting. Liquidity, what are you seeing there? Hannes, yeah.
Yeah, being a senior secured lender, we're on the boring end of things, so it's core plus. And their competition for good projects is immense. Also one of the trigger points where you said, okay, where do you see the leverage or so? The sustainability of things might extend or raise the appetite for higher leverage, whereas worse KPIs might need a capex or a good strategy from the lender to make it bankable at all. So there is a divide in the market where you see assets that are flooded with offers and some that really struggle to find the right financing.
Okay, good. Matthew, what's your take?
The lending landscape has materially changed. If you look at just a couple of snapshots, if you go back to post-GFC, so traditional lenders, just from a UK perspective, accounted for 70% of all lending, with alternative lenders making up the 30%. alternative lenders being naming insurance companies and debt funds. That's more likely, the position now is more likely to be 40% traditional lenders, 60% alternative lenders. In Europe, the alternative lenders account for 30%. So still some material room to grow. And why is that different? Why is that important? Because alternative lenders obviously have the ability to underwrite more complex credit. They can think with an equity hat. If you look at the amount of credit in terms of dry powder that's being raised over the past 5 years, it's huge. And I think the key challenge in the market is just the difficulty with being able to deploy that credit into credit instruments. So therefore, people are struggling to find those credit opportunities, and therefore we're seeing tighter pricing, more structural flexibility to be provided with covenants, for instance, and therefore it's really a borrower's market.
Okay, borrower's market. Is it a borrower's market, Duco?
Yeah, I would definitely say yes, it is. The nuance between the UK and the continent, I would make that in the UK, on less asset classes, that is accretive. Obviously, the Bank of England still has some time to go for the rate cutting cycle, and Europe is a bit ahead of that. And on prime product, I already made that comment. So definitely a borrower's market.
I think that's short term, though, right? I think that it is a borrower's market today, undoubtedly. But I think that as we see transaction volumes come back, we're going to start to see a little bit more normalization. Yeah. You're seeing a lot of capital desperately being deployed, giving up on structure, giving up on pricing. It's great for borrowers, not great for our business, but I do believe, and I have to believe, that it will normalize.
Okay, good. And in terms of challenges in your market, Hannes, what are you seeing there?
It's the same old story. So if you look at it as perspective from the outside, there is political risk, there are political changes every day. But on the other hand, we live through so many of them that it's basically the new normal. You just start over and the market doesn't stop. Other than that, we are happy that the growth rates in the eastern part of the European Union are stronger than on the western part, at least at some countries, majority Austria and then Germany. We see a steady inflow of capital, so we also believe that the transaction market will be picking up. So this is lacking to UK market or Western European market. So we also hope that this will come up for 2026 in our region.
Okay, great. And Laurent, you're obviously seeing, people trying to structure finance deals, what's coming through your offices or that you're seeing. So I guess, what are some of the key challenges that they're seeing in terms of getting financing? What makes it a nightmare for you, Laurent, sometimes?
We recently advised a few transactions on prime properties, and there was really no problem in getting the financing. Approximately 60% of lending, 40% of equity, margins around 2, development a little bit higher, about 2.5 margin. The real challenge is refinancing existing buildings that are not prime, where it's not fully let, where some works have to be done. From a residential perspective, if I look at Luxembourg, what is really a nightmare is turnkey investment, so getting individuals invest in apartments, in flats that are being built. They do not have any confidence in the promoters, in the developers. Banks do not want to finance it. So what we see for our clients, and our clients invest a lot in the German market and also in the Luxembourg market, is for good products, no problem. For all the rest, it remains quite heavily.
Okay, good. Might be interesting, Matthew, just to pick up with you in terms of, who's borrowing, what are they looking for, what types of situations are you seeing?
The most active clients are typically the private equity houses, and obviously I think their leverage requirements have increased. Typically now they're looking for 60, 65%, possibly higher, 70% loan to value on investment deals. If it's a development financing, they could be looking for 65, 70% loan to cost. And what we have seen in the market is very consistent with the US market, is an increase in terms of sponsors seeking cover-light facilities. So therefore, those loan transactions that don't have default covenants. If I go back 5 years, probably 2 to 3 sponsors in the UK and Europe could dictate those terms. It's probably more like 12 now. So the market's growing pretty quickly from that perspective and working in the sponsors' favour.
Okay. And are we seeing, it'd be interesting just to pick up with you, David, Are we still seeing institutional capital still very much wanting to put money into the debt funds? Are we seeing that that is still popular in terms of, let's say, the investment opportunity coming through?
Yeah, I would say absolutely. I think, all of our current investors and investors that we speak to on a day-to-day basis are all very institutionalized on a global basis too. I think people are recognizing, if you look back at one point, kind of the flavor of the month was value add. At one point, it was equity. As I mentioned, 24 months ago, maybe it was debt. I think everyone's starting to realize that from a portfolio composition perspective, if you're starting to think about how you want to allocate capital, ultimately on behalf of pensioners, insurance holders, you need to think about portfolio composition, and there's value to real estate credit. It's no longer about equity returns for debt-like risk. I've never really believed in that statement in the first place, but I do think that having that kind of fixed income, relatively well first loss protected investment at a reasonably high yield relative to the risk, even in a lower interest rate environment, is very attractive. And we're seeing that across all types of institutional investors globally.
And are we seeing more new entrants coming into the market?
Yeah, absolutely. I think, there's a lot of people trying to figure out how to approach real estate credit. And there's always this grid. When you walk into a meeting, you're wondering, am I talking to a credit person that's looking at us relative to maybe corporate credit, or a real estate person that's looking at us maybe relative to real estate equity, or somewhere in between? And, I think that, people are starting to recognize that value. They're starting to figure out what real estate credit looks like from a risk perspective, understanding what back financing is. That's a big flavor of the month in terms of people starting to think about how that has an impact of the underlying positions. But a lot of new entrants who are starting to realize that it's a great place to put your capital in the long term.
And are you seeing that, Hannes, as well in your region?
Yes, to a certain extent. So back leveraging and stuff is not so common because there are the fund briefs, the covered bonds. There are also still, as we are talking about the European Union, funds to be deployed for infrastructure projects and other cheap sources of funding. But overall, yes, this is how it works, and this is where the liquidity comes from.
Okay, good. And maybe just to pick up on liquidity, risk pricing, loans to value, how do you see that? Where are we at the moment? Maybe start with you, Matthew, on that.
No, I touched on this earlier slightly. So I think from a senior perspective, senior loan to values across the market, typically 55, 60%, sometimes higher. And pricing, if we looked at a prime UK asset, be it living or logistics or even office in the UK, you could price a margin spread basis close to 150. If we go to Germany, for instance, if you're looking at a prime living opportunity, slightly lower LTV, you could get close to 100 basis points. There's quite a bit of delta there between the regional markets, but definitely strong liquidity for prime opportunities.
And how does that play out if we start to look at sectors? Are there preferred sectors? Are there, if we're comparing office with retail with data centers, for example, or
100%. So that the strongest sectors from a debt liquidity perspective remain living in logistics. But having said that, if we were advising on a prime best-in-class office opportunity, we would expect pricing to be pretty consistent. I think where you take a look at the office sector in particular, where the office, for instance, is more secondary or tertiary in nature, then liquidity materially reduces and pricing exponentially increases. And it actually, sometimes for those opportunities, it can be difficult to secure financing at all. I think for living and logistics, even if you move slightly up the risk curve, liquidity is still there, but obviously pricing moves out slightly. I think in terms of, we're seeing a lot of interest in terms of alternative sectors, being operational real estate.
okay.
So hospitality, care homes, self-storage, cold storage, you can get slightly higher yield, stronger cash flow, and obviously lenders are spending the time to educate themselves on the key credit considerations for those sectors. We as a firm are number one in terms of global data center advisory. So we currently advise on a lot of situations. We've got a number of mandates in the market from a European perspective, and the data center space is obviously on the back of the AI investments is really interesting because provided you've got the land, you've got the power, you've got the planning, you've got the takeout in terms of a signed up tenant, be it a hyperscaler, you can theoretically fully fund these from a debt financing perspective. So your equity is already in the land, and we can go to market through an infrastructure lender, a real estate lender, seek loan to cost financing up to 90%, and we're talking about margins in the 200 bits. So very, very attractive.
Okay, good. And Duco, from your side, when you're borrowing, I guess, what are the things that either make a deal fly or make it fall, or, you know, are people willing to lend on everything, whether that's development, you know, so how do you see that? Well, I suppose, is it more complex for some sectors than others, or is it, you know, there are complications with all of them, really?
Yeah, no, there are indeed complications. In principle, I fully echo what Matthew said about living logistics still being the flavor of the day. On the other hand, if you would look now, how much traditional lenders still look at offices compared to, let's say, 18 months, 24 months ago. For prime offices, there's definitely liquidity. It's not only about maximum LTVs, it's more about the capabilities of an operator, the business plan behind it, to really make sure that that asset is not only in shape today, but will remain in shape. So when we say every deal need to take all boxes for a lender, what does it actually mean? They look beyond the real estate credentials. It's not only about asset class, country, location. It's about the operator. It's about the risk in terms of what are the debt requirements. And from a borrower's perspective, it's not only about pricing. This is about, can we get that CapEx line in place, because otherwise the business plan will not fly and we will not continue. And all elements play a role. And final point, which is really applicable in today's market, is that every deal seems to take enormous amount of time. There are enhanced risk assessments for the banks. Risk teams are closer involved. They are sounding multiple times with their credit teams, etc.
Okay, yes, go on.
Yeah, I can fully concur to what Duco said. Maybe not on the timing, so we try to be quick to the market, but everything else, it
I'm
works.
sure Duco didn't mean you.
But, yeah, and in regards to asset classes in our region, data centers would be nice, but we are not in hyperscale territory, not yet. Maybe it comes one day. I also see hospitality as undervalued and a good opportunity in the market. Where there's a little bit, the glitter gone is logistics, I have the feeling, but this has to do with Germany and automotive sector, especially. This could turn a little bit in our region once the defense funds are flowing in, so there will be light industrial and logistics space needed. And office is coming back if it's a good product. What is resilient through it all the time, retail, dominant schemes, they run come hell and weather.
Yeah, we were looking, on that point, we were looking at kind of the price differential between Class A and Class B offices in major cities. And from a yield perspective, you're seeing somewhere between 200 and 400 bip spread between a Class A and a Class B office. So I think fundamentally what we're talking about here is really where's value, and where can you take conviction on value, and what is value? And it's an interview question. I think it's a good one, because you can talk about the theory and you can talk about the practicality, and the practicality is based on arm's length sales. But that is, you know, there's a varying degree of liquidity in all of these different asset classes as well. So how are you valuing these assets, and where are you comfortable from a lending perspective, I think is the bigger question.
Okay, good. And Laurent, what are you seeing in terms of, I guess, are people mainly looking for CapEx? Are they mainly looking for acquisition financing? What are you seeing coming through your desk?
Mostly acquisition and refinancing of existing loans. And
Okay.
what we see that the lenders are looking also at is long-term leases, AAA tenants, and then they do not really care if it's office or residential anymore. So I think the possibility of the project of generating long-term stable cash in order to serve the debt is also a key for most of the lenders. I haven't seen margins of 1%. You should put me into contact with the people that give 1% margin.
That's my job.
So what we've seen is mostly 2% for existing assets, little bit below developments, or at least during the development phase, a little bit higher, going down once development is finished. And also there, you can get financing for development if your building is fully let from the beginning on, then it's quite easy. But if you have a development, no tenants, no possible acquisitions, nothing, then it gets very, very hard.
And in terms of, be interesting to get your view, David, and also yours, Matthew, on, we just had a very popular session this morning, which was on senior living, healthcare, aspects that have not necessarily been so easy to finance going forward. But how do you see those alternatives? You mentioned data centers already, but there's obviously, different sectors that are, what were they called? The future core was how they were described in the at the time. So what are you seeing there?
I'd say future core is maybe a little aggressive on that front. I think, look, we do have an aging population. We do have a diminishing population. We have less people coming into the workforce. And there is a concentration of wealth towards the older part of our population. So I do think that there is a movement in that direction. I also think as we evolve as human beings, we're getting better at later life through to end-of-life care. So I think that's an interesting sector. The question is, who's going to support that? And I think, it's interesting. I was talking to someone much more intelligent than I was over the weekend who broke it down and said, look, the reality is there's two types of real estate at the end of the day. There's consumer and there's corporate. And so, you can talk about senior living, you can talk about student housing and everything in between, and you can talk about logistics, two very different types of tenants, two very different underwrites. And that for me was a really interesting conversation because, they're obviously interlinked. We're obviously kind of, one is reliant on the other. But, I would come back around and say, overall, very interesting, but there's a wide range of products that's being delivered in those spaces. And again, it's not thematic for me. It's much more about where is a specific and concentrated demand factor and where can that be provided at a cost basis that makes sense.
And Matthew, what's your take on that if we're looking at some of those more alternative or non-core sectors, and I guess including development, which had been very difficult to finance over the last couple of years? How are you seeing that?
No, I fully agree with David in terms of the demand and supply. I think a lot of liquidity is materially lower for those subsectors, but you need a lender who can work closely, typically with an equity side of their investment business that fully understands the sector. So when we work on these types of situations, we have expertise in terms of colleagues that value these underlying businesses and assets. So we provide a lot of marketing data support to help the credit help the lender convince their credit teams in terms of the overriding fundamentals to support the deal. But it's not a quick fix. It's a hard process. Liquidity is materially lower, as I've said, but the market is evolving.
Okay, good. Just want to pick up a little bit on locations as well. And if anybody's got a question, do let me know because we will answer it. And the best time to let me know is now while the session is on rather than after it. So if you've got one, just put your hand up or shout out loudly, whatever is needed to get my attention. Let's look a little bit at the geographies. Let's start with you, Duco. What are you seeing in terms of, I guess, the differences between, let's say, you're operating in Germany, Spain, Italy, Nordics. So are you seeing differences in those different markets?
Living and logistics is definitely interesting in pretty much all the countries. But if you look, for instance, at retail, then you do see retail, including shopping centers in Southern Europe being of high interest, not only of investment managers, but also of lenders. Offices is more about the urban destinations and the locations. So I would say this is not country specific, but this is more city specific. The main capitals, the top cities in Germany, there you definitely see liquidity for it. Absolutely.
Okay, good. Hannes, good to get your view on Central and Eastern Europe especially.
Sure. We are currently in the process of acquiring a bank in Poland, Santander. So obviously we believe in the market. As you said, prime products, it's there. Logistics might be a little bit on a turning point, but at least it's on a stable high plateau. With retail, we are very happy with it. We had quite a big chunk in our portfolio during COVID, and we had to do like numerous cases and stress tests and whatever. It happened nearly nothing. So we went through it, and this gave us the feeling also to our credit teams that there is a resilience in the market. Yes, we're talking about online and everything else, and the growth rates are there, even in Eastern Europe, not to the extent that in Western Europe, but they are there. Still, destination shopping, dominant schemes where you spend time. This is a quality cash flow. You also get like super experienced sponsors and operators there, and you buy the whole package, and then you're in, and it's very stable business.
If I may comment to that, I think for retail specifically, I fully agree. What has happened since Corona is that basically the whole retail sector has evolved. So before that, we were talking about retail and everything was one basket. If you look now, we are talking about convenience retail, we're talking about high street, we're talking about shopping centers. Every bank has their own views as well, and it has evolved. If you look at offices, it's much more about urban destinations. It's not only about the building itself, connectivity, of course, but also about the surroundings. It's about urban destinations.
Okay, good. A few quick fire ones because there's about 10 minutes left. So last year I mentioned mezzanine and the room went silent. So what's the situation now? Might we, are we beginning to get more capital coming back that's interested in that?
We talking about German mezzanine or real mezzanine?
Well, I was in Germany at the time, obviously. So, but I could tell you the room went silent. So.
Look, I've said this before. I think when you look at this from a capital structure perspective, and when we talk about 90% loan to cost or 100% loan to cost, I argue that's mispriced equity in favor of your borrower. So borrowers should be taking that all day long. But as a lender, I struggle to call that mezzanine lending. I think mezzanine lending, when you break up a capital structure, you have your senior, you have your mezzanine, and you need some alignment of interest with your borrower in the equity. Now, there's different sides to that argument, but I think that that market has normalized, and that 95, 100% plus loan to cost debt that was coming into certain European markets. We saw that same thing happen in the United States in 2006, 2007, and it was a very similar kind of secondary effect in terms of where the pricing of assets went. Of course they went up. And so, at some point you need to normalize, and I think that, mezzanine does make sense in a lot of instances, but pure true mezzanine. So yes, you're seeing it come back, but in a way that it should be, and in a part of the capital structure whereby you're sitting in front of a truly incentivized borrower who's putting real equity into your project.
Okay, good. Any other views on that?
Yeah, we've gone to the market on a number of situations, be it if it's asset disposals, joint ventures, or financing. And it's interesting in terms of you've seen a material change in terms of how equity investors respond to these situations. So a lot of equity investors have pivoted to structured credit solutions. So we receive a lot of interest in terms of whole loan solutions. David will hate me for this, but going up to 90, 95% loan to cost. So from an equity perspective, they weren't quite happy with it, but they've pivoted, and actually we've been able to get the deal done at favorable terms.
Okay, good. Just pick up a little bit as well on acquisitions, acquisition finance versus refinancing. Obviously, a lot of the capital was involved in refinancings. Do we expect that to begin to free up a little bit in 2026 if we see more acquisitions coming into the market? Do we expect that there to be a change over there?
I truly hope so, otherwise life gets boring. So you're shuffling from left to right, but we need transactions to make the market lively and liquid.
So we see, just put some numbers to this, right? We see about 50 to 60 billion euros of transaction volume every year. And that's actually remained pretty flat for the last 5 years or so. 2023 and 2024, acquisition financing. We divide it up into acquisition financing, refinancings, and then we carve out developments as well. So we have 3 categories. Acquisition financing historically has been 40 to 50% of our pipeline until COVID. 2023 and 2024, it was somewhere between 8 and 15%. And anytime it was over 10%, that was generally an outlier transaction. So a really big, billboard style acquisition. 2025, January, that was around 15 to 20% on any given week. April, tariff day, dropped to 7%. And it's now ticking back up to kind of mid-20s. So we were at 21% as of this morning on our pipeline. So I think that we are seeing it come back. We're seeing capital come into the market. So I wouldn't worry too much. I think that trend will continue. And again, it comes back to value. People are now willing and buyers and sellers on both sides of the trade. So we're seeing that happen.
And in terms of elements like sustainability, decarbonisation, transition, what are we seeing there? Is that less on the table now? Is it a given? In terms of, I suppose, as a borrower, is that something that is being driven by the banks and the investor side?
I would say it's a given by now. Yes, it used to be driven by the investor side. Lenders followed quickly thereafter. Even those banks that didn't have a clear sustainability strategy were being pressured by the central bank in the last couple of years. But now this is embedded. So what does it mean? I would say that if you are a manager seeking debt on a brown asset without a clear brown to green strategy, without a clear business plan, it's almost unbankable, if not unbankable.
Which I think should be the
Definitely,
case. Oh, good.
So, we don't have to talk and educate sponsors about it. They know it. They are asked by their tenants, and we are the ones that are asking it again. And as I said, if you don't have a plan to get a brown to green, then it's hard to get financing at all.
Which fundamentally should be the case, right? Like you're seeing a material improvement in your operating costs. And also more consistency in your operating costs when you can create a more efficient building. And that inherently should derive value. And we're seeing that. We're seeing that now as things are starting to trade a little bit more. And that, as a result, I think has been normalized. It's no longer a new concept. It's standard. It's expected. Our investors want it. Our borrowers actually want it as well. So green lending is a big part of what we do. And I think it's logical.
And it also obviously mitigates refinancing risks in terms of capital preservation or increasing value. But one thing I would say is that lenders are being more flexible in terms of, I agree in terms of the business plan, but for instance, we've recently closed a number of deals where we don't have to have a committed capex to support the business plan. It's more on an understanding with the sponsor that they're going to do it. So lenders are being amenable and flexible to working with sponsors.
Okay, good. Final question for me, which is for everybody, which is when we're here in a year's time at EXPO Real talking about that, what will be the key topic?
I think data centers.
Ah, okay.
I'd say data centers will be the talk of the next 12 months. I think there's a lot of capital flowing into it. I don't quite understand where the magnitude of capital comes from an exit perspective. And I think that the landscape for data centers is changing. So I think, the need for data centers is clear. How we finance that from debt and equity and get comfortable with what those exits look like is where I would question that. And I think we'll see a lot of developments in the next 12 months.
Okay, interesting.
Defense and how it interacts with real estate, definitely.
Okay.
I would say on the risk side, I truly hope that the capital markets remain less volatile. Obviously, there's lots of geopolitical risk embedded in the capital markets, so that could quickly turn up, but I hope that will not be the case. On the positive side, I would definitely say transaction market is back on track again.
Great. Matthew?
No, I think I agree with David. I think data centers is going to be the hot topic for the next 12 to 24 months and beyond. And if you take a look at the US, for instance, it typically transcends over here. And the volumes being closed and printed over there are huge. So we've seen situations with deals for 20 billion, 30 billion. Not saying that's going to be repeated here, but typically I'd expect it to follow in some form of magnitude.
Okay, great. Laurent, last word to you.
Yeah, we see also a little bit in the hyperscalers, they're investing massively in Spain because energy is very, very cheap there. Very often these are infrastructure investors and not any more real estate investors. I think we need confidence in the market, political stability, and trust, and then everything will be good.
Great. Thank you, everybody. Thanks very much for joining us for this session. Really interesting. And I will check. I'm already making notes for that to see whether that is what we're discussing next year. The next session that we've got here starts in, let's see. Oh, 8 minutes, it would appear. And we're going to be looking at projects. We're going to be looking at the leading projects and what you need to really get a project off the ground. Looking at those, looking at logistics ones, looking at different structures. So join us for that, and then there is drinks after that. But in the meantime, thanks very much to everybody who's watching online. Thank you to everybody here in the room, and if you could join me in thanking the speakers and yourselves, that would be great. Thank you, everybody.